Assalamualaikum friends, welcome to question number 12. Before I start question number 12, I want to make an announcement. So whoever is there in my LinkedIn, they know it, and whoever is not there in my LinkedIn account, okay, I have yesterday I have made an announcement. I have posted on my LinkedIn that what is that paper which you want me to start teaching for the December exam, okay, December 2021 exam. I will be starting the classes from September. After the September exam gets over, I will be starting the classes for the December exam. So I have given four options. One was AAA, APM, and AAA, APM, ATX, and taxation F6. And I also told that if someone wants me to teach paper other than the four given in the option, you can inbox me. You can message me directly. Okay, if you are supposed to vote, so I will choose the one based on the whichever is getting the highest vote. I will i will be teaching that subject, okay, but that vote is not only taken from my LinkedIn. I will also be taking vote from my other social media accounts also. For example, on my Insta, on my Facebook, right, and also on YouTube. You can comment in the comment section below that which paper you want me to teach for December. I mean, for December exam, I'll be obviously starting earlier. From September I'll be starting, so September, October, November, 3 months will be that, okay, because I'll be teaching any one paper. Okay, it's not possible for me to teach more than one paper, so you can only select one paper. Okay, some of them might have more than one, but only one only I can take. Okay, so now that was the announcement I wanted to make, and let us start question 12, right? So we have the background on the draft financial statements. Okay, Parsley is the parent company. Okay, he's making investment in two companies. One is Sage, one is Saffron. Okay, and all the three companies make their financial statements in accordance with IFRS, and the presentation currency of the group is dollar. That means they make their financial statements in dollar. Okay, but Saffron's, okay, Saffron is in franc. Okay, for Saffron's, their functional currency. Okay, you have been given the draft profit and loss for the year ended 30th April 2004. Okay, now sale of shares in Sage. That means sale, you are selling it, and then we have accusation of Saffron. Then we have a lease. Okay, so we are going to study a new standard on lease, IFRS 16. Okay, and then also we have related parties. Okay, a question relating to related parties. So now let us go to the requirements first. What are we supposed to do? Under A, there are three requirements. Discuss with calculations how Parsley should account for Sage in the consolidated statement of profit and loss and other comprehensive income. Okay, this is for Sage. Okay, next is same question, but this is for Saffron, and the marks are same. Okay, it's just the companies are different. Third is about lease agreement. Explain how this lease should be accounted in the consolidated financial statements. Same year, okay, and same marks 888. Okay, wherever you have to adjust entries, you have to show it. Okay, adjusting entries are required. Next is about related parties. Okay, which we'll go through it later. Let us first go through the case study. I'm not going to read the whole case study. I'm only going to read the sale of shares in Sage because that is what we need for our first requirement. Okay. Parsley acquires 70%. So the moment they acquire 70%, Sage become a subsidiary. Okay. How much? 1 million, $1 share for 6 million many years ago. Okay. They didn't give the date when it was acquired. Okay. But 1 million, they have got it for 6 million. They have given you the consideration. Okay. The reason why they are giving you the consideration is, you might be asking that now they are selling, why do we want to know when they acquired and for how much? They will always give you that for the goodwill calculation, because goodwill you have to de-recognize goodwill. Remember, when you acquire a subsidiary, you calculate goodwill. That goodwill, when you are selling it, you de-recognize. So that goodwill needs to be calculated. That's why you are given the purchase consideration. Okay. At the acquisition date, the carrying value, net assets also you'll be given. Three things you'll be given. One is purchase consideration. Purchase consideration could be in any form. It could be shares, it could be cash, it could be deferred cash. Okay. Number one. Number two, NCI, fair value of NCI and fair value of net assets. These three things you need for your goodwill calculation. So they will give you the information regarding these three. Okay. Net asset is 5 million and it is deemed to be same as their fair value. NCI was measured using the proportion of net assets method. Okay, that means they will not give you the fair value. You have to find out. How will you find out? It is the 30% of your net asset, then your NCI. Okay, and goodwill arising on the acquisition of Sage has 6. So goodwill is what? Goodwill is 6.5 million. When you have acquired, this is the goodwill they calculated. Fair value of interest retained. You also need to find out what is the fair value of interest retained. Remember, when you are selling shares, if you are not selling completely, okay, you need the fair value, whatever the amount you're retaining, whatever the proportion you're retaining, you need the fair value for that. Okay, you have acquired 70%. How much you are selling? They have not given here, but they just told you have acquired 70%. Okay, that means when you are selling it, you're having some, you are not completely selling it off. Okay, maybe 30% you are selling, 40% you are selling. So the remaining is the remaining interest is valued at fair value, which is 9.5 million. Retain earnings, okay, definitely profit and loss and other comprehensive income they told to calculate, right, in requirements. So they will give information of return earnings of the subsidiary, which is 9 million at this date, 30th April 2003. The old entry posted in Parsley's individual financial statements to record the cash received and to credit this proceeds to a suspense account. What did they do? They recorded the cash received and credit this proceeds to a suspense account. That means cash debit, suspense account credit. Okay. Because when you're selling Sage, what happened? The amount that you are getting, it's cash, no? Parsley is the parent who is receiving that cash. So cash received debit, and he does not know where to credit, so suspense account credit. Okay, whatever the proceeds he got by selling it. Next. Okay, acquisition of saffron, we are going to read it later for the next second requirement. Let us answer the first requirement for 8 marks. So how do you start with this? Okay, focus on group accounting issues. Lost control of Sage during the year. Okay, you need to understand that he lost the control. Sage is therefore consolidated until the disposal date. So you do not consolidate after you lose control, because then you are not a subsidiary. You only consolidate when you are a subsidiary. So until the disposal date, you consolidate. Also, the profit and loss on disposal must be calculated. You need to calculate profit or loss on disposal. When you're selling a subsidiary, what is their profit or loss? That needs to be calculated. Okay. So Saffron is an overseas subsidiary. Which this is an overseas subsidiary, Saffron. Okay. That's why they have given the functional currency as another currency. Okay, which is not dollar. So what happened? Because remember, we always have to translate what according to the group. Okay, what is the group's presentation currency? We have to translate that. So the group's presentation currency is dollar. So that overseas subsidiaries financial statements needs to be translated to dollar. Okay. Exchange differences on the retranslation of Saffron's operating net assets, profit and goodwill are recorded in OCI. Exchange differences. Okay, we record exchange differences in OCI. Because when we retranslate the saffron, what do we retranslate? The opening net assets, the profit, the goodwill, all are recorded where? OCI. Okay. Next. So let's start group structure. Okay. So first, what is the group structure? Group structure is Parsley have bought two. Okay. One is Sage, one is Saffron. Sage he bought for 70% and Saffron he bought for 60%, but this is for full year. because it's not selling of separate. But Sage, if you see, only for 6 months. That means they are holding only 40%. They're selling of 30%. Okay. Is it given somewhere how much they're selling it? Just uh, did they mention anywhere that they're selling? Okay, I have missed out that part, because if you can see, there's a line here, right? It went under that line, so that's why you cannot say it. Because if you see here, rest all is relating to. Okay, so I'm sorry for that mistake. I didn't see that when I copy pasted it, that line didn't come. I'm so sorry for it. So for 6 months. Okay, next we are starting with Sage. Okay, so you need to memorize the pro forma for calculating profit or loss rising on the disposal of a subsidiary. This can be worth a lot of marks in the exam. Okay, now what happened? He lost control. These are the keywords. You need to mention this. Whenever a sale comes, whether he lost control or not, that is the first line you have to start with. So Parsley lost control halfway. Okay, only for 6 months they lost control. What does it mean? Consolidate line by line. You need to write all this for 6 months. First 6 months only you will consolidate. How you will consolidate? Line by line basis. Sales, then cost of sales, then your expenses, line by line of the Sage. Next, you are going to the profit, right? Sage made a profit for the year of 6 million. So how will Parsley have to consolidate that? Parsley is the parent, right? How will he consolidate that profit? They will take 6 over 6 months, so it's 3 million only they will consolidate. But from this 3 million, what they will consolidate, of this 2.1 million is for the parent, and balance is for the NCI, which is 0.9, because 70% you have to take of 3 million. Okay, whenever the profit you give, profit you should always give it like this. You have to divide it between owners and the NCI. You just cannot write profit. You have to write profit 70% for the out of that profit, and the balance for NCI. Okay, so we'll see the Sage's profit. Okay, so here you can see how much profit they got. This is Sage's profit. You see 6 million. So this only they are taking 6 months and consolidating, and on that they are taking 70 and 30%. Okay. Next, a profit and loss on disposal. So now you need to find a profit or loss on disposal of Sage. This, because this also will be go in the consolidated statement of profit or loss. How will it be calculated? This is the pro forma. Please memorize this pro forma. Okay. Just give me a time. So here, what is the proceed from disposal? You are selling it for 6.5. Okay. With that, whatever the portion you are retaining, the fair value of that you are adding it. So 9.5. So the total is 16. Okay. From here, you are deducting. This is pro forma. Okay. Memorize it. Goodwill disposed. Okay. Definitely, you are deducting the goodwill disposed. For that, you need to calculate goodwill first. What is the goodwill? This is the formula for goodwill. Consideration plus fair value of NCI minus net assets at acquisition. So consideration, you have bought it for 6 million. NCI is what? 5 million they have given as net asset. Out of that 30%, because we calculate NCI using proportionate method, not the fair value. 30%, and NCI at acquisition is 5 million, the net assets. Okay, so you deduct it, and 2.5 is the goodwill at disposal. So from the 16, you minus 2.5. Okay, and you need to take further this thing. Okay, net assets at disposal. What is the net assets at disposal you need to take? You need to minus net assets at disposal also. Not only goodwill. You need to deduct all this. First goodwill, net, then net assets. So net assets, how do you calculate? Share capital plus retained earnings plus profit. So share capital is 1, retained earnings is 9, brought forward, and profit, which is only 6 months of the 6 million. Okay, so only 3 million you are taking. Okay. So net assets at disposal net assets at disposal is addition of this 1 plus 9 plus 3. We'll check the share capital and the retained earnings 9. If you see the share capital, okay, here they have given you 1 million, 1 share. This is your share capital of Sage. You see, from here you are getting it. And retained earnings you will get from here. This 9 million is the retained earnings of Sage. So you are taking this too. Okay. Next. Net as NCI at disposal. So NCI at disposal you need to add, okay? How do you calculate NCI at disposal? NCI at acquisition plus this. So NCI at acquisition is 1.5 plus the NCI percentage of post acquisition net assets. Okay, first we'll see NCI at acquisition is 1.5. How it is 1.5. Okay, we have just calculated NCI 1.5. You can go up and check here. This is this NCI, okay? This 1.5 you have to take. NCI at acquisition. After that, you are taking the post acquisition net assets, okay? 30% only, okay? 13 minus 5. Because your net asset is 5 and before it was net asset was 13. We'll see how your net asset was 13 before. Okay. Net assets. Okay, I think that line is missed out here. So because of that, but definitely you have the question with you, the textbook. So okay, it must be given somewhere that 13. Okay. Oh, oops, so okay, okay, sorry. This that 13 they have got from here. This 13. Okay, that 13 only. This one. Net assets at disposal. Okay, so this is net assets at disposal 13 and 5 is net assets at acquisition. So 13 minus 5, the post acquisition. Okay, whenever you want to find the post acquisition net asset, it is the difference between the net asset at disposal minus net assets at acquisition. 13 minus 5 into 30% of it, you take it and 3.9. Okay, finally what you get is it's a profit at disposal. Okay, all the steps you need to memorize. So now, after the share sale, Parsley retains significant influence over sale. How much they retain? Significant influence over Sage. That means they are an associate. More than 20 but less than 50%. This means that Sage is an associate for final 6 months. And because it is associate, what should they do? Use equity method. So when you are using equity method, the group will show its share of associates profit as how? As a single line in the consolidated statement of profit or loss. Okay, remember your profit and loss or other comprehensive income. One line is there in that where they say associates profit or associate share of profit. You write it as one single line there. Okay, and how much it will be? Profit is 6 million. Out of it only for 6 months and 40% because your associate is 40%. You have sold up 30%. Okay. Now we are going to the second one, saffron. But before going to the saffron, let me see whether I can read this line or not. What was missed here? Uh, Okay, so so far as I can read this line, okay, I can read it. Acquisition of Sage has never been impaired. On 31st October 2002, Parsley sold 300,000 of its shares in Sage for 6.5 million. Okay, they have sold 300,000. So here they didn't say. See, every time they will not tell you they have sold 30%, they have sold 40%. They will not give in terms of percentage. So when they don't give in terms of percentage, how do you find out? It's simple. How many shares they have sold? 300,000. And how many shares you have? 1 million. So just find the proportion, the percentage, 30%, right? That means they have sold 30%, so now they are having 40%. From 70, if they are sold 30, they are remaining with 40%. You see? So now let us go to the next one, Saffron. Okay, accusation of Saffron. On 1st May 2003, acquired purchased 60% against subsidiary for how many? 1 million ordinary shares at this currency. Okay, you have to change the currency. NCI is at this one using the fair value method. Okay, FR 29 million and net asset is FR 60, but fair value is this one 70. You see, carrying value is 60 versus fair value is 70. So excess in fair value. Why that excess? So that excess in fair value was due to an unrecognized brand with an remaining useful life of 5 years at the acquisition date. Unrecognized brand, life of 5 years. Why they are giving? This is an intangible asset. The reason they are giving you is to find amortization. Okay. So that means the difference between the carrying and the fair value is the unrecognized brand. Okay, that is the intangible asset. At 30th April, it was determined goodwill arising in accusation was impaired. How much the goodwill was impaired? By 4 FR 4 million. So you have been given the exchange rates, okay? Opening, closing, and the average. Before we go to list, okay? So 5, 4, and 4.6. That means on 1st May 2003, 5 FR is equal to $1. It's like that, okay? That's how you read it. So in here, we need to use exchange rates. Now, unlike the first one, where easily we could calculate. So how do you start? You start with profit or loss. Question asked you profit or loss or other comprehensive income. Okay. Which standard you are using? IFRS 3. Because IFRS 3 talks about business combination. What does it say? So you are explaining also, you are doing the calculation also. Says identifiable net assets as subsidiary must be consolidated at fair value. Whenever there are two options, one is at carrying value, one is fair value, one is at cost, one is fair value. You have to write according to standard. You will measure or you will consolidate at which price? Fair value or carrying value or historical cost. What does the standard say? So this is how you need to write your answers, build up your answers. Okay, so IFRS 3 says net assets at fair value. Net assets of whom? Of the subsidiary should be consolidated at fair value. It would seem that Saffron has a brand that is unrecognized in its individual financial statements but which must be consolidated at its fair value. Yes, it could be recognized in individual, but when it's in the consolidation process, it's at fair value. Now you are calculating the fair value of the brand. So next comes the calculation. So we know fair value of net assets is 70, carrying amount is 60. The difference is the fair value of brand. Okay, this you need to amortize. Okay, so amortization must be charged on the brand. In the current period, this will be 10 divided by 5 years, isn't it? Because useful life was 5 years. That means FR 2 million. Next, Saffron is what? Saffron is not any subsidiary, overseas subsidiary. Mention it that it's an overseas subsidiary. The reason why you are mentioning overseas subsidiary means you need to convert it. Okay, that's why you're writing the word overseas subsidiary. So it results includes above amortization adjustment. Must be translated for inclusion in the consolidated statement of profit and loss and other comprehensive income at the average rate. So you're explaining an item by item. How are you dealing with amortization? First of all, you're including it in consolidated statement of profit or loss and other comprehensive income, isn't it? It's an expense. It will go at what rate? Average rate. You also need to mention the rate whenever what overseas subsidiaries are there. Whenever you have to translate the foreign to your local currency, remember always what rate you are using, you need to write. Okay, and all the items which goes in your profit or loss and other comprehensive income are always translated at the average rate. That's why amortization will be translated at what rate? Average rate. Okay. The results of Saffron will then be consolidated line by line. Okay, they'll be consolidated line by line because they are subsidiary. They have never been sold. Net impact on consolidated profit will be how much? This is the consolidated profit. If you see, it is written in dollar 6.1 million. How did they get that? Just right beside it, the working is there. Okay, make this a habit that you always show the working beside the number. How did you get it? It is 6.086 something. They have rounded up to one decimal place. Okay, 6.1 million. It's a profit when you convert. So for example, amortization, what is it? You have to convert it into dollar. Okay. So here they are saying FR30 per PNL. That means according to profit and loss account, it was 30 minus the 2 amortization. Now you have got amortization divided by 4.6 because average rate is 4.6. Okay. When you want to convert it into dollar, you need to divide it because FR and the amortization, FR per PNL and amortization are both in FR, right? Even the exchange rate, the average rate is FR per dollar. So you need to divide because same currency. Okay, both are FR. 4.6 and also 30 and 2. When you divide, you will get in terms of dollar. Okay, we'll see how according to PNL they got FR30. Because if you see saffron, okay, this is the profit of saffron. So from this 30 you need to minus what? And this is in FR, okay, it's not in dollar. If you see here, this is in dollar million, this is in dollar million, but this is in FR million. Always check the currency. So that means as 30 minus 2, that amortization will be deducted and then you need to divide by 4.6, 4.6, this rate. Yeah. So 4.6, okay, which is 6.1 million. From the 6.1 million, of this 3.7 million will be for the parents and the balance is 2.4 is for the NCI. Remember, whatever you get that profit, okay, that profit always you need to divide it between the parent and the NCI. 60% for the parent and 40% for NCI, okay, of that 6.1 million profit. Next, we are coming to the goodwill impairment and foreign exchange. Just wait, give me some time. Okay. So goodwill and impairment, okay, always use subheading like this to show that is about goodwill impairment. What should we do? Calculate goodwill in the subsidiary's currency. First you calculate goodwill in their currency only and then you translate at the closing rate because goodwill is intangible asset. Assets are recorded in the statement of financial position. Statement of financial position items are translated at the closing rate. Hence, goodwill also will be translated at closing rate. But the okay, so the foreign exchange gain or loss is recorded in OCI, okay, not profit or loss account. Always remember that foreign exchange gain or loss are recognized in OCI. Okay, and it is classified as what item that may be classified to profit and loss account in the future. Now we are starting with the goodwill. So we calculate the goodwill of Saffron first in their currency. That means you need to mention the name of the currency on top, FR million. So you start with the cost of acquisition. We have acquired it for 71. You can see the case studies given there. Then the fair value of inside acquisition is this one, 29. List fair value of net assets at acquisition, which is 70. Okay, they have clearly given it. They have given the carrying amount of net assets as 60, but we have to take the fair value, therefore 70. Okay, and goodwill is 30. They have told that impairment is 4 FR million. So goodwill at reporting date is 26 million. Okay, so this 26 million will need to be translated at the closing rate. Okay, that's what they've written. So this gives rise to foreign exchange gain also, loss also. It is foreign exchange gain in this case when you translate at the using the closing rate. Okay, make sure that you follow this table. especially when you're doing foreign exchange gain or loss. Learn this pro forma. First you are writing in the subsidiaries currency, then the rate which you are using, then the currency after converting. So you start with acquisition, then impairment, then foreign exchange gain or retranslation. Basically this is like the balancing figure, okay? This at the end only you will find out. So what was at acquisition? So goodwill at acquisition, that's what they have asked. You can take it from here, it is 30, this one. Okay, 30 impairment is for, hence at reporting date it is 26. Then the rate we are using, acquisition at the opening rate 5, impairment at average rate. Okay, we divide 30 by 5 or 4 by 4.6. Hence acquisition minus impairment, this one. Okay, 1.4. But when we are taking this 26 divided by 4, we are getting 6.5. Right? So now what you need to go? You need to go backwards. Okay, this is question mark. We don't know this one. So 6.5 plus 0.9 minus 6, you'll get 1.4. And plus, since it's a positive figure, it's a gain. Okay, gain on retranslation. And remember that gain will go in OCI. Okay, so now where will the impairment go? Don't leave the impairment alone. Impairment is an expense. Impairment of 0.9, where will it go? 0.19 million means the dollar amount you are taking. It is recorded in PNL. Okay, but you have to take the proportion of parent and NCI. Never forget it always. Okay, so out of it, 60% will be for the parent and balance 0.4 is for the NCI. Next, we are going to the gain of 1.4 million. The foreign exchange gain. So that gain, where will it go? OCI. And here also same way you have to take. Even it does not matter whether it's under profit or loss or under OCI. Still, proportion between parent and NCI needs to be done and needs to be shown. So 1.4, 60% will be for the parent and balance is for the NCI. 0.6. Now we are going to the foreign exchange gain on opening net assets and profit. This is the gain on which opening net assets and profit. Okay, this is different. This was for acquisition of goodwill minus impairment. Basically, it's on goodwill when you're translating goodwill. But this one, you also need to translate the opening net assets and profit. So opening net asset is 70. You need to use the rate. Opening rate you are using 5. 70 divided by 5, hence 14. Okay. Okay. Here also it is same rate and then dollar million. Then the profit we are getting it. How are we getting the profit? It is already done. FR 30 minus 2. From profit you minus amortization 28. This you are using the average rate because profit comes where? In profit and loss account. Profit and losses are always translated using average rate, therefore 4.6. So you are getting 6.1 here. Okay, this is also balancing figure. So 70 plus 28. Opening net assets plus profit is 98. Then we have 4 because this is the closing figure. Hence 98 divided by 4 is 24.5. Right? So when you go backwards, 24.5 minus 6.1 minus 14, you will get 4.4. Again, it's a positive number. It's a gain on a retranslation. Okay. So opening net assets, you are taking the fair value of net assets. Okay. 70. Don't take 60. Next, this gain also will go in OCI. Okay. So the gain of 4.4 million will go in other comprehensive income. Here also you need to divide between the parent and the NCI. So out of that 4.4 million gain, 60% is for the parent, hence 2.6, and 40% is for the NCI, 1.8 million is for NCI because 40% of 4.4 million. Now we are going to the third item, which is lease. You need to use subheadings like this when you're writing it. What does the tutorial note says? Okay, before going to the tutorial note, let us go through the lease. On first, Parsley acquired a lease to use an item of machinery. The useful economic life of the machine and the lease term were both 5 years. Okay. Lease payments are due annually in advance. The lease payment for the first year was 1.2 million. Parsley's rate of borrowing is 10%. Present value of the lease payments excluding the payment made on first was 3.8 million is the present value of lease payment. Okay. Lease payment increases annually by the rate of inflation over the previous 12 months. On first of May, inflation for the prior 12 months was 8%. The lease was correctly accounted for in accordance with IFRS 16. In the year ended 30th April 2003, the only entry made in the current year is to record the cash payment made. What was the only entry made in the current year? Cash payment made to the lessor within the cost of sales. It is within the cost of sales. That means whatever the cash payment you have to make to your lessor, that is within cost of sales. Okay, so you need to write how the lease agreement needs to be accounted for in the consolidated financial statements. Consolidated financial statements mean it can come anywhere, profit and loss, and also statement of financial position. Okay, and wherever you have to adjust, maybe some figure might be in the wrong place. It's wrong. You need to adjust the error. That also you need to show for 8 marks. Okay, so now let us go through leases. To determine the accounting entries in the second year of the lease, you will need to determine the carrying amount of this lease liability and the right of use at the end of first year. Remember, whenever you need accounting entries in the second year, you need information from the first year because the first year's opening balance will be the closing balance will be the second year's opening balance. Therefore, you need the carrying amount of two things. One is lease liability, one is right of use asset. Okay. At the end of the first year, you need the carrying amount of this two to determine what will be the accounting entry in the second year. Okay, this is like a hint they are giving you. So year ended 30th April 2003. Which standard are you using? IFRS 16. Clear. The word lease means IFRS 16 only. So how do you recognize your lease liability? How do you recognize your right of use as asset? This too you are explaining in two different paragraphs. The first paragraph talks about lease liability. Second paragraph talks about right of use asset. How they are recognized using IFRS 16. Okay. So let us go to the lease liability. Lease liability we recognize at present value of payments yet to be made. Okay. This includes what? Fixed lease payments as well as variable payments. Okay. Fixed plus variable payments based on the relevant index or rate at the start of the lease. The liability is reduced by cash payment. This will be reduced by cash payments. Interest on the liability increases its carrying amount and is charged to P&L. Okay, the interest on the liability increases its carrying amount and will be charged to P&L. Definitely, where will the interest of the loan go? Or interest of a liability? Loan is a liability only. Profit and loss account. No? So same way here also it goes. It's like a liability. So that goes in the profit and loss account. Okay, and it increases the carrying amount of the liability also. Because with the liability you have to pay interest also. You're understanding. No, it's like loan. When you take a loan, interest plus the principal amount of the loan. So because of the interest, it increases the carrying amount of the loan. So it's like the same thing, same principle. Now we are going to the second right of use asset. This is like an asset only. So everything relating to it will be asset. This has the features of asset. Okay. So how is it recognized? This is the formula. Okay. It's there in your textbook, right? Better you memorize it. Initial lease liability. That means the opening balance of the lease liability. Plus payments made before or at commencement and initial direct cost. You are adding it. Okay, that is known right of use asset. So assuming that cost model is chosen, the asset is depreciated over the lower of the lease term and the remaining useful. How do you depreciate asset? Because this is an asset, I told you this has the features of asset. So you need to depreciate. How do you depreciate? Based on which year? Because lease term and useful economic life of the machinery might be two different years. But in this case, the good thing is both are 5 years. So you don't have to decide. But usually the deciding factor is lower of the two, whichever is lower, whether your lease term or whether your remaining useful economic life. Let's say, for example, your lease term is for 2 years, but your remaining economic useful life is for 5 years. So you have to depreciate, you have to divide it by 2 years, because 2 is lower of less than 5. Lower of the two you have to take, okay? But if both are same, then it's easy. That's 5 only. So in the prior year, the right of use asset would have been recognized at 5 million. How? 3.8 plus 1.2. We'll go and check 3.8 plus 1.2. What does this figure mean? Because what was the formula for to calculate the right of use asset? It is the present value of lease payment. So present value of lease payment is 3.8 plus 1.2. What 1.2? Lease payment. So the first lease payment was 1.2. You have to add this two. That's how you are getting 5. Are you understanding? So that's 5 million. Okay, now on this 5 million, you need to divide by 5 here. It's easy. So depreciation will be 1 million because 5 right of use asset is 5 divided by 5 here. And the carrying amount will be 4 million. Okay, of the asset at the end of the prior year. How? Because depreciation is 1 million and your right of use asset is 5 million. So 5 minus 1 is 4. Okay, next. The lease liability would have been recorded at 3.8 million. This is the lease liability. Interest of 0.8 million would have charged to P&L. Okay, interest. How? On that lease liability, 3.8 is the opening balance. On that opening balance, you charge interest at 10%. They have given you. So that amount will go to profit and loss account. Okay, interest of 0.38 million. As such, liability would be, because we told that when interest is there, interest plus the principal amount, the liability will increase the carrying amount of the liability. Therefore, you are adding the interest with the liability amount, which is 4.18 at this date, 30th April 2003. Okay, but now we are going to the next year. The year ended 30th April 2004. This is a critical year. Most of the major calculation is under this year. So remember that you are asked to provide an explanation. Calculations and double entries are not enough to score high mark. If changes to lease payments occur, then the liability must be recalculated and adjusted. Okay? If you change the lease payment, what should you do? Liability must be recalculated. You cannot use the same liability as before and it needs to be adjusted. Okay, so the corresponding entry is made against the carrying amount of the right of use asset. Based on the inflation for the last 12 months, lease payment now due each year as because of inflation. Okay, the payments are changing, so your lease liability also will change. How much it will be? It will be 1.3 million because 1.2 into 108%. Because your payment was 1.2 million. Now you have to increase it by inflation by 108%. We'll see. Because inflation was what? 8%. Right? If you forgot, let me show you that inflation is what? 8%. That means 100 plus 8%. So 108%. Okay? So you're increasing it. Now what are you doing? Finding out the revised liability, because we told that liability needs to be changed. So what is the revised liability? Okay, you can learn this pro forma also. When a question on lease comes like this, when you need to do revised liability. Okay, you're writing the cash, you're writing the discount factor and present value. Okay, how many years? 3, 4, 5, 6. Okay, we'll just check out the number of years. Just give me a time. Whether they told 4 years or not. Okay, so it is on 1st of May 2002 and the lease was for when? 5 years. Okay, so starting from 2002, 2003, 4, 5, 6, 2, 3, 4, 5, 6. So 2002, 2003, 2004, 2005, 2006. Okay, so 2002 is the current year, so you need for 2003, 4, 5 and 6. Okay, 4 years. because okay, so first of 2003, 4, 5 and 6. After 2002, cash is 1.3 only. Okay, it's already given there. But now discounting factor they have given you the 10%. So this discount, this is how you discount, okay? This is the formula. 1 divided by 1 plus discount to the power to the number of years. Then we found the present value, then add together, this is your revised liability. Okay, 4.53. Lease liability must be increased from 4.18 to 4.53. You see the increase? Before, how much was your lease liability? If you check. This is for 30th April 2004, but just check here. It was 4.18, isn't it? So from 4.18, it has increased to 4.53. So how do you increase lease liability? By crediting lease liability by the difference between 4.53 and 4.18, therefore 0.35. This will increase, and right of use asset also will increase by the same amount. Okay, because lease liability will increase means right of use asset will also increase. Because how do we find right of use asset? Remember the formula? It is the lease liability, present value of lease liability plus, oh god, come on, you cannot forget, just now we went through it. It is initial lease liability plus the payments made before and initial direct costs. So initial lease liability. So lease liability. So if your lease liability increases, that is the starting point. Your right of use asset also will increase by the same amount. Now there are so many adjustments. I know it's easy to get confused. That's why I would suggest that practice more and more such questions. Okay, if not same questions but similar questions, you can practice and practice until you get the figures right. After this adjustment, right of use asset is held at this one. 4.35 million after this adjustment. Why? Before right of use asset was how much? It was 4 million. Remember initially before this we have calculated. You can go back to my video and check that we got 4. With that now you are adding 0.35. So 4.35. Okay, depreciation will be 1.09. How? Before it was divided by 5 years. Now your right of use asset, since first you need to adjust your right of use asset, which is now 4.35, not 4. And this also will change. Before it was 5, now next year it one more year will reduce. So it's 4 years. So depreciation is an expense that needs to be debited, and right of use asset needs to be credited because of depreciation your value of right of use asset goes down. Therefore, depreciation credit here, right of use asset and debit as an expense. Now, basically you need to change everything. Everything changes. Depreciation is adjusted, right of use asset is adjusted, lease liability is adjusted, cost of sales needs to be adjusted, your interest is an expense, so finance cost needs to be adjusted. Okay. Carrying amount of the right of use asset. What is the carrying amount of the right of use asset at the year end is 3.26 million. How? From that 4.35 million, where is it? This one. You deduct the depreciation, 1.09. Okay, that's why carrying amount is this one. Now, the current year cash repayment has been incorrectly it has been charged to profit and loss account. The current year cash repayment, isn't it? How do you know? It has been mentioned in the case study. That lease was correctly accorded, but the old entry made in the current year is to record the cash payment made to the lessor within the cost of sales. So it is included within cost of sales, the cash payment, which is wrong, right? We don't write cash payment in the cost of sales. Cost of sales is profit or loss only, because cost of sales we write it in profit or loss account only. No, so incorrectly it is charged there. So that's why, because it is in the cost of sales, okay, cash repayment, that means it might have been debited. Now you need to credit that. Okay, cost of sales credit 1.3 and lease liability you need to debit because your liability will go down 1.3, this original payment. Okay, so you debit and you credit cost of sales. Okay, because of a cash repayment lease liability will go down. That's why debit lease liability and credit cost of sales, because you want to take it out from the cost of sales. That's why credit. Interest on the outstanding lease liability. Now what is the interest on the outstanding lease liability? It is 0.32 million. How? So interest is 10% only. How? The difference between 4.53 and 1.3. You need to minus 1.3 from 4.53. Because your lease liability is how much? The new lease liability, 4.53. Right of use asset is also 4.53. It is 4.53. Lease liability, we have just calculated it. This one. You see, revised liability. This 4.53. You go down. That revised liability only. From there, you need to deduct 1.3. Right? Because it is debited. That means liability is going down. So 4.53 minus 1.3 into 10%, that is your interest. Okay. This will go in your profit and loss account. So debit finance, it's an interest. So debit is an expense, and credit lease liability, because lease liability will go further up. It's like every year you keep on adding that interest with the lease liability amount. Okay. So now what will be the carrying amount of the lease liability at the year end? 3.55 million. How? Revised liability is this much minus 1.3. That was your because your lease liability reduced by 1.3, and also by that payment, right? Plus 0.32. What is this 0.32? This is that interest. Every year interest will be added. Minus payment plus interest. Minus payment plus interest with the lease liability amount. Okay. So this is the this is done to find the carrying amount. Okay. So this is how you find the carrying amount. Now we are going to part B. I know that it's a little bit confusing because too much of working is there, but make sure that you go it over and over again. Now we are going to the related party, which is I-24. Related party relationships are particularly key concern when preparing financial statements for group entities. Objective is to ensure the financial statements contain necessary disclosure to make users aware of the possibility that financial statements may have been affected by the existence of related parties. You need to know who are related parties. Remember, not everyone who looks like they are related are not related. Okay, there are certain key information which you need to find out whether they are related parties or not. Why this is a key concern? Because of related parties, an ethical issue. Okay, a lot of ethical issues used to come out from related party, right? A lot of things or crimes which is being concealed or hidden in an organization is due to related parties. It's like you are auditing in your father's company. You are working as an auditor for your father's company, right? Because you both have a personal relationship. So your decision will not be objective, right? It's like you're advocating. So that's why you both are related parties. So because of the related party, it will have an impact on the organization. Okay. So what is the question? We don't know the number of marks, but describe the main circumstances that give rise to related parties. What are the main circumstances? This is a pure textbook knowledge. In such questions, you can pick up a lot of marks easily because you must. These are textbook knowledge, right? Main circumstances that give rise. How does related party? What are the circumstances? What does it give? How does it? They are related parties. What are the circumstances that can increase the related parties? And explain. And the moment and means there are two requirements in one. Okay, explain why the disclosure of related party transactions is important. Why do you need to disclose related party relationships in the transaction? Why is it so important? That also you need to explain. Okay, so just let me go through the marking scheme. So it is for 6 marks. Okay, I just wanted to see the marking scheme to see the number of points is for 6 marks. That means we can divide equally 3 for definitely this answer is longer than 6 marks. So the whole textbook it's like copy pasted here. Okay, so I can quickly go through the answer, because definitely when I will be explaining IS-24 I will be explaining you there in detail. Okay, so if you have not understood here, it's okay, because I will explain in IS-24. Here I will be going a little faster. Okay, IS-24, basically this standard says that who are related parties. Okay, a person or a close member of their family is related to the reporting entity of that person. Okay, so these are the points. Remember these points. has control, joint control or significant influence over the reporting entity. Okay, that means control means subsidiary, joint control means joint venture, a joint operation, and significant influence means it's an associate. Okay, they are an associate of the reporting entity. Second, member of key management personnel, they are the key top level people of the reporting entity or its parent. Next, so these are some who are related to the reporting entity. Next is, these are the main circumstances that lead an entity to be being related to the reporting entity. What are they? They have given 4 points. Entity and the reporting entity are members of the same group. Okay, that means if there are two subsidiaries, let's say subsidiary A and subsidiary B, and they have the same parent, then they are related. The two subsidiaries are related. Or the parent and the subsidiary, they are related because they are in the same group. Remember, associate does not come in the group. Associate is not a part of a group, so it cannot be. But yes, a subsidiary and a parent, they are in a group, so they are related. One entity is an associate or a joint venture of the other. Okay. One entity is the associate of another or a joint venture of another. They are related. Both entities are joint venture of the same third party. Then also they are related. The entity is controlled or jointly controlled by a person who is a related party of the reporting entity. Okay. Now, in the absence of the related party disclosure, now they are talking about the disclosure. Okay. If they are not disclosed, what happens? Because you need to say why they are important. Users of financial statements, they assume that entity has acted independently and its own and in its own best interest. They assume it, right? If you don't disclose that they are related parties, we assume they're independent. And most importantly, they would assume that all transactions have been entered into willingly at an arm's length. This is an important word. Key word is this. They assume that transactions are all at arm's length. What does it mean? This is the definition for arm's length. Normal commercial terms at fair value. Because we know if it's related value, for example, if you are selling an item to your, let's say you and your father in the same business, okay, and you want to sell something, you will be selling at a lower price, no, than the normal price. You will be giving some discount, some negotiation is there because you both are related, you know each other. That is not at fair value and that is not at normal commercial terms. How the normal commercial terms would look like, okay, and it is not in the arm's length. But it is assumed that it's an arm's length because you didn't disclose that you both are related parties. Okay, so where related party relationships and transaction exist, these assumptions may not be justified. You cannot justify the assumption. When related party exists, you need to disclose it. So related party relationships and transactions may distort the financial position. Yes, it can distort the financial position and performance. That's why it's very important. Second reason is this. At least 3 points you can give, three importance. First, this is the first important, there's the second one, and that's the third one. Okay. Both favorably and unfavorably. Okay. In both ways it can affect. The most obvious example of this type of transaction would be the sale of goods from one party to another on non-commercial terms. On non-commercial terms, right? When you're selling goods, let's say from the parent to subsidiary or subsidiary to parent, they might be selling at goods which are non-commercial. Third, it is a common misapprehension that related parties transactions need only be disclosed if they are not on market terms. This is not the case. No, no, no. Most of the people think it's like a misunderstanding that they only need to disclose if they are not on market terms. But that's not the case. Even if they are market term or not, they need to disclose. Okay. For example, a parent may instruct. See, wherever you are finding it tough to explain, use examples. Okay. Use examples to understand. You will still get full marks. How they have used an examples over here. So example, a parent may instruct all members of his group to buy certain products or service on commercial terms from one of his subsidiaries. Okay, parent are saying to subsidiaries, all the subsidiaries, that when you buy from each other, buy on commercial terms only. Okay, if the parent were to sell the subsidiary, it would be important for the prospective buyer to be aware that the related party transaction would probably not occur in the future. Okay, it's important that the buyer knows that there will be no related party transactions between the two of them in the future also. They need to be aware. So that is the third, and here they have given the fourth reason also, which is not needed because it's 3 points you can write and for the circumstances and 3 points why it's important. So this is given for your, because you are learning from the revision kit solutions. Examiners know that, so they have included all the possible answers. But in the exam, make sure that you only write according to the marks and not more than that. So let us read it. Even where there has been no related party transaction, it is still important for some related party relationships to be disclosed. A subsidiary may obtain custom, receive favorable credit ratings, and benefit from a superior management team. They may obtain what custom? Favorable credit ratings also they can receive, the subsidiary. Or they can benefit from what? Superior management team. Simply by being a part of well-respected group. As such, an entity must always disclose information about its parent. Always. Okay. So with that we have finished question number 12. Now let us go to the marking scheme. 8 marks for the first three and 6 marks for related parties. So 1 mark per point for all the 4 requirements. Okay. This shows that how you need to spread your points across how many paragraphs, how many points you need to write. This tells you. That means to get 8 marks, you need to write 8 points. Okay. So with that, I have finished and see you in the next question 13.